Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for the channel. I greatly appreciate it. This week up, we're going to take a look at LVMH, the absolute behemoth in the premium brands and luxury good items industry. It's a French company, public on the pink sheets here in the States. It's also public in Europe. And I want to just kind of look through this. I also did a due diligence trip to Scotland to review the Scotch whiskey holdings that LVMH has. And I want to take a look at that brand, how it fits into the overall portfolio, and how do we look at a particular asset relative to the giant conglomerate when we're looking at a growth story. So I want to remind you some of the brands this behemoth owns. Right? Maybe 72 different brands. This company owns Dom Perignon, Hennessy, and Ardbeg are the whiskey and spirit companies, wine spirits, and Ardbeg is the distillery I visited in Scotland for my due diligence trip. They also own Christian Dior, Fendi, Louis Vuitton, obviously. They own Hennessy, Marc Jacobs, Tag Heuer, and they just bought Tiffany & Company, the jewelry company. This giant company is a roll-up of high-end brands. That's what they do. They go out and they have a giant war chest of a balance sheet, and if they have a luxury brand out there that is doing well and sustainable that they believe for the long term, they buy it and hold it. So it's a very interesting company. Let's figure out how much cash money LVMH makes, and we'll figure out how much we want to pay for it. Ready? Let's get to work. All right, the first thing I want to do is I'll pull up the annual report for LVMH. And take a look at kind of what the breakup of their business is. Behind me is their annual report last fiscal year. I'm on page 21. Quick highlights: 80 countries they operate in, employees 175,000. That's an absolute beast. Revenue 64 billion euros. These are all in euros. Profit 17.2. A titan, an absolute behemoth again. Global distribution, fairly dispersed. Revenue distribution, you can see that most of their business comes from the fashion leather goods business. Almost 50% of their revenue comes from this region. Perfumes, watches, jewelry, other, and the spirit section. Now, I went to the Ardbeg distillery on the island of Islay in Scotland to kind of figure out what's going on in the whiskey market. I do like whiskey. Whiskey prices are up a lot, and I wanted to figure out who's going to benefit from this. So I did a quick tour, and what you'll quickly notice is that the whiskey spirits section as a whole is 9% of the portfolio, and then within this you have brands like Dom Perignon, Hennessy, and others that are much bigger than Ardbeg. So Ardbeg itself is a small fraction of this. So even if Ardbeg doubled in size, which they're planning to do, I'll get to later, how material is that to a company that's already doing 64 billion euros annually in top-line revenue? The answer is it's very insignificant. So this lesson here is going to be a reminder of when companies come out with great news, you have to put it in context to the overall portfolio and how much incremental earnings does that truly deliver. A lot of stocks, such as the Teslas, the Apples, the Microsofts of the world, get pops on announcements of new products, but realistically, how often does that really truly double the bottom line for them? And that's what we're looking for. So let's dive into the financials of LVMH, a really amazing company, and I truly enjoyed reading through this. If you are in France and you want to own shares, you can join the shareholder club. It gets access to all kinds of very interesting newsletters. It also can visit the mansions within this company for some of the brands, the legacy brands that they own. Very interesting shareholder rewards if you're in France. Other than that, let's enjoy it and take a look. All right, here we go. Okay, before we start with looking at LVMH, let's review the 5 key attributes that we use in this channel to value all securities as a starting point for how we look at it. Number 1, top-line revenue growth. Gotta have top-line revenue growth. Number 2, EBITDA. Earnings growth needs to be grown. Number 3, strong free cash flow. Number 4, low debt. And 5, a well-priced stock. What is a well-priced stock? It is a stock with a conservative growth forecast that beats the market, a high likelihood of outperforming the market. That is what you want. You want to create a portfolio of 20 to 30 stocks, all collectively over a 10-year period of time have a high probability of outperforming the market. That's a good shot at then having a portfolio that will beat the market. Okay, here we go. 29 billion euros of revenue in 2013, and that has grown very steadily to 64 billion euros last fiscal year, with a small drop here at COVID, which makes sense, right? They're a luxury retail brand, or rather they're just a retail company in general. With a global meltdown, economic shutdown, people are going to naturally cut back. You expect that. But what's interesting here is the rebound that happened. Now, I will give you a small bit of anecdotal evidence, just what I saw here in the States when we were giving stimulus checks out to a lot of other people, when the Fed was printing money and they were doing this all over the world. I saw a lot of people taking their stimulus money and going to brand and luxury good companies and buying high-end products. I saw lines at Tiffany's. I saw lines at the Rolex store, although they don't own Rolex. I saw a line at Fendi. These are retail companies you would not normally think of having lines to get into the store. Part of it was just occupancy restrictions, but part of it was people wanting to spend their stimulus money. So for me, this 64 billion euro of revenue to me seems a little bit high, and I would be cautious that they can't maintain, or at least the growth forecast going forward would be a little muted because of the stimulus bump, but still growing. The other thing is they made several acquisitions during this time frame. They acquired Christian Dior, and they also acquired Tiffany's in a major acquisition, which also bumps up the revenue. So some of this is organic growth, some of it's bolt-on acquisitions, which they had to come out of pocket with cash to go do. So when we're looking at long-term forecasting, I'm going to bring forecasting down below this number because we're just assuming organic growth. Acquisitions would be on top of that. But it does check the box for growth. Great job team. EBITDA, earnings before interest, tax, depreciation, and amortization, is also growing. 7, 8, 8.4, 10, 11, so forth to 19. Again, referencing that spike in both dollar amount and margin, I think was driven by the pandemic level spending. Might come down slightly. But I will say that the growth rate here in earnings is faster than revenue. They are able to acquire a company like Tiffany's, like Christian Dior, roll it into their enterprise, streamline synergies, the back office. That means laying people off, by the way. But that means they keep most of the earnings. They don't need the management there. They already have a management team, and margins grow. So I like to see that. It's a very strong track record of being able to execute that. Debt. Almost 9 billion euro to 34 billion euro. That's a monster growth, but then again, earnings has also grown very quickly. We'll see what that stacks up like when we look at ratios. Excess cash, they do have excess cash. They got a lot of cash on the balance sheet, right? They use that as a cushion to be conservative, but they also use it to go out and buy high-branded, high-value companies that they want. And I'll do one more comment. This company itself has a large family ownership position in the enterprise, and so they run it like they want to own it for 100 years. They use leverage very, very sparingly and have a lot of cash on the balance sheet, which I truly like. Market cap has grown substantially over this time. I think it was a little bit of a kind of forgotten story here during this period, and they started making acquisitions recently with Dior, with Tiffany's, and the market is giving them credit for going out, that they're going to continue to go out and buy brands and bolt on other big companies like that. So they're willing to pay in advance of that acquisition. That's why you're seeing the rapid growth in the market cap. So 370 billion euro is the market cap. The enterprise value, 75 billion euro, up to almost 400 billion in euro. That's a very, very rapid growth, partly on earnings, partly on market multiple. So we always look at this market multiple as a relative measure, right? It's the enterprise value divided by earnings, much like price earning, PE ratio, price per share divided by earnings per share. This is at the enterprise level as a whole, the enterprise value divided by earnings. Our estimate of earnings is EBITDA. So prior to the acquisitions, this company was trading at 10 times EBITDA. Cheap for a wonderful company. And then they start making acquisitions. The market says, oh my God, these guys are going to go out and continue to buy up the world. Let's pay everything we can for them. And so the market multiple literally doubled. What does that mean? That means this column here, which is a reflection of earnings. Earnings grew, great, fine, but market multiple also expanded. So the same amount of earnings that they're generating here, $7 billion, received a $75 billion valuation at 10 times. This here, if this was still the same, this $7 billion at a 20 times would be double this. It'd be $150 billion for doing nothing more than the Wall Street, the street willing to pay more for the same number of earnings. So they had two things working for them. One, a market multiple expansion that doubled, and two, very strong EBITDA growth, which is what we want to see. And ideally, we want to be here when we're investing in this business and take advantage of this part of what I call the trifecta, where you've got massive earnings growth, you've got market multiple expansion, and the shareholder count is reduced. That's the trifecta that we look for. I think this stock right now is kind of at the end of that. I would like to see this come back down, but we're going to see what this looks like on a forecast basis in a second. So a little context there on the enterprise value. Debt has been 1 to 2 times EBITDA. Very reasonable. This is net debt. Very reasonable, even though debt has gone up from $9 billion to $34 billion. Look at earnings. Earnings have more than doubled. So I'm comfortable with the level of debt that they're currently using. They seem to be prudent about the market price that they're paying for Tiffany's, for Christian Dior. So I like where the business is positioned. Let's take a look at cash flow. Okay, before we look at cash flow, I want to remind you that I do teach a course on how to be a financial analyst. Check the link down below in the description to go to my website, cashflowinvestingpro.com. I give you this Excel sheet and we walk through Apple as an example. Okay, here we go. Cash flow from operations, that's the first third of the balance sheet. That's the real cash money they made by selling their Fendi bags, by selling Hennessy and Ardbeg whiskey. 4.7 billion euros in 2013. That has grown to 18 billion euros last year at 19% on an annualized growth rate. Now that 19 ties into the 14 times growth rate for EBITDA. That means our income statement and our cash flow statements are lining up, and the accounting team isn't playing funny with numbers. Great job, accounting team. Love that. Thank you for all your hard work. Doing a great job. They printed almost 19 billion euros selling liquor, handbag, watches. I mean, unbelievable amount of jack that's piled up, and they're like, what do I do with it? Oh, I just stick it in the bank. And you're seeing excess cash grow as a result. Right? So now what do? So they printed $19 billion last year in hard cash. Okay, well, I have to peel off a little bit of money and put it back into the factories that make the handbags, the watches. I've got to reinvest in communication systems and infrastructure, maybe redo the headquarters. They've got mansions that they want to maintain for tourists and so forth. They have a publication just for the shareholders that they want to maintain. All of that, well, maybe not a publication, they would expense that, but all of the infrastructure needs to be replenished. That's this cash. And you don't put it through the income statement. It's called capitalizing something. It basically says that I'm going to invest in this thing, this asset, or it could be IP, and it has a life that's longer than a year. And therefore, I'm not going to put it in the income statement all at once. I'm going to put it in the balance sheet as an asset, and I'm going to expense it over time through depreciation. And it allows me to take a big investment, a 2.6 billion euro investment, make that and string it out over time. And what hits the income statement is really only a fraction of this number. That's why it's important to always look at the cash flow statement, because the cash going out the door is greater than the income shown on the income statement. So 18 billion euro that they generated, up substantially. Now they only peeled off 2.6 billion. That's nothing. That means that they have 16 billion euros sitting in a pile, and they're like, what do I do with this? I don't know, let's go buy something else. So that's the value of a business. Business's value is based on this free cash flow. Now, here you've got the debt piece, which they've been paying down. They borrowed some money here, they paid some down money, but their leverage ratio for us is below the 3x. So we can kind of put this aside. we can say, you know what, I'm just going to zero this out for a while so we get a kind of a cleaner look at their income, at their cash flow. So this is cash flow to the equity holders, putting aside debt for a minute because they don't have to pay it down. And that means that they spiked to $16 billion of pure cash that can go to the shareholders because everybody's already satisfied. They have 504 million shares outstanding. And again, they have not been buying back shares. That's part of the trifecta that we look for. I would like to see them buy back shares. They're not. That's okay. But that means that this $16 billion flows through to all these shareholders, and that means it's a $31 per share free cash flow yield. Now that is extremely high to me. And when I look historically, I'm not seeing, at least when I put debt aside, I'm seeing numbers in the 16, 15 range. This seems to be a very big banner year, in my opinion, for free cash flow. And I don't think, given the economic headwinds that are coming down, they're going to repeat that number. Now, that said, their currency is in euro, and if the euro declines in value, then US dollar sales or yen sales reported back in euro would be higher. So take this for a grain of salt. If the euro depreciates, then their earnings can actually grow. But I'm going to put aside the currency issues because who knows what the macro landscape looks like. And I'm just going to say, I think this seems like a little atypical to me. I agree it's growing, but I'm not going to give them credit for the $31 and just grow that going forward. I'm going to keep it closer to what they have been doing in the past. And I'll say that this stock, it's been yielding 4% or so. The price per share has run up astronomically recently because of this giant print. $700 where it was 250. It was 130 euro just a couple years ago. So that's the cash flow, and I'll put this back. That's the cash flow. I think we can definitely check the box that they make a lot of cash. Let's forecast this business and figure out how much we think it's worth. Okay, let's forecast this business forward. Now, we know that they were growing at 14% EBITDA growth historically. Now, some of that growth includes acquisitions, and we don't want to assume further acquisitions because A, we don't know when or how they're going to show up, what price they're going to have to pay, and then B, that cash flow comes from us. It's not organic, so it's going to lower the free cash flow. So what we want to do is grow. We want to estimate the organic growth rate for the existing business, and that's about 6.5%. And when I look at the years that they don't make big acquisitions, they're growing about 6.5%. And what I'm also going to do is I'm going to bring down the market multiple back down to something more reasonable for A, a company that's growing 6.5%, and then B, for the company that has experienced this type of multiple in the past. I don't think the 20 times is an appropriate amount of money to pay for this business currently. That's going to mean I'm looking at a 448 billion euro valuation. I take off some debt, I add some cash, 400 million of market cap. Shares outstanding is 500 million, means that there's a $792.90 per euro value for the shares out 10 years based on the EBITDA market multiple approach with a conservative 6.5% growth and a conservative 12 times market multiple. Now, free cash flow. What I said earlier is that free cash flow at 30 was too high in my opinion. And what I think is that is based on stimulus money that was going into the high-end brand. And I think that's going to come down a little bit as people tighten their belt and don't spend a lot of money on Scotch whiskey or for perfumes or handbags and so forth. The uber wealthy will always continue to do that, but that middle group that's trying to step up into those luxury brands, I think could come off. So if it's my money, I'm going to hedge my bets and give a lower cash number that they can grow. So I'm paying at 15.5 free cash flow, growing at 16.5% with a 4.7% yield, which is slightly higher than what they've been trading at in the past. And I get a 580 euro price target out 10 years. Okay, let's take a look at this stock now. I can buy as many shares as I want at 700 euros per share right now in the market. I've got two different valuation methods. I did a free cash flow method, and I get a 580 euros per share. I got a EBITDA market multiple method, and I get just shy of 800. So I split the difference. call it $680, 680 euro per share. Now it's trading at 700, so that means to me that's pretty fully valued, depending upon the cash flow it's going to generate or kick off. Now, if I put that into an IRR distribution, I get the pro rata share of earnings, cash flow that are going to generate every year. But I don't get a lot of capital appreciation because I'm assuming the market multiple comes back down. As growth wanes, the market multiple should come down as this free money that we've been printing for years washes out of the system. We should see market multiple compression throughout the financial markets, especially, by the way, as interest rates rise. Conservative investors who have been in the stock market, who've been in the real estate market chasing yield, you've heard of that comment for chasing yield, they're going to move into the bond market because bonds are higher up in the capital stack table, so they have preferred claim on assets ahead of common stock owners for corporations. So if a corporate bond is paying 6-7% interest and a pension fund needs 5%, they're going to take that over investing in the common stock equity for the dividend to be more conservative. And that migration of money from equities and real estate into the bond market is going to reduce the demand for stocks. It's going to bring down the market multiples. So I think that you have to bake that into your assumption when you're looking out 10 years. And what this does is this means with essentially no capital appreciation, just this cash flow, I'm looking at a 3% cash flow yield. Now I can put this into a distribution, and at $700, it's 3%. If it grows, I'm definitely not a buyer. I would wait for the stock to pull back before you buy the stock. Now let's review the 5 key attributes. Number 1, top line revenue growth. Yes, it's growing. Number 2, EBITDA. Enterprise level earnings is growing. Yes, check the box. Number 3, strong free cash flow. Absolutely. I love the cash flow here. Number 4, low debt. Yes, it is low debt. Number 5, well priced. No, I do not think it's well priced because I think there's a market multiple contraction that is coming. And you already see it from 24 to 20. Well, that's because of the earnings spikes. But I do think that this number comes back down. And if you can pick it up in the teens, like 15, 16 range, I don't know if you're going to get as cheap as the 10s. But if you put it in your radar, you might. You never know. But I think buying it right now at the current multiple is probably a little too rich. And I think you're banking too much on just a flat line of the stock price, and the cash flow yield isn't big enough to really get you where you want to go. So that's the review for LVMH. I want to thank you very much. Take a look at this spreadsheet. I do teach a course in the description below at my website, cashflowinvestingpro.com, where I give you this worksheet. I teach you how to be a financial analyst. We go through 10Ks of Apple, 10 years of them. We pull out revenue, EBITDA, debt. We look at share splits, how to adjust for that, how to go get that data, and help you understand how to build a forecast of a business. That over time, you're going to learn how to do this, and it'll teach you, and you can learn it and keep it for the rest of your life. It's something if you did once, you'll know how to do it forever, and that'll make you a better investor long term, and it's well worth the investment. Additionally, I do have a club, a cash flow club in the upper left-hand corner at the website. You can download a free one-pager in the description below. But these one-pagers, we publish multiple every month on lots of stocks that I can't obviously publish on YouTube all the time. But what you're getting here is you're getting 10 years of cash flow data. You're getting my summary of what are the 5 key attributes, and you're getting a forecast as well as commentary. And what I would recommend doing is if you find a stock that you like, you print it out, you put it on the desk, and over time you look at it, and when the market price comes to you, you already have the detail in front of you that you can quickly make an assessment. Now, as for a rating for the LVMH, I'm going to give it a rating of, what should we rate it? I'm going to rate it a meh, because I like the company. I like the management. I like the conservative balance sheet. I love the brands that they have. I love the long-term thinking. I like everything about the company itself. I just don't like the premium that's currently being charged for the stock. I want to wait for that to come back down. Finally, our lesson on Scotch whiskey. By flying out there, I learned that they are doubling their capacity. In fact, a lot of the distilleries on the island of Islay, which makes very peated Scotch, such as Ardbeg, which is owned by LVMH, they are doubling their capacity to meet the insatiable demand for Scotch whiskey. That is great for them. They've built a whole new warehouse that's twice the number of stills. They're going like crazy, and they're very excited to very build that. But when I look at their earnings relative to the entire enterprise, Ardbeg doesn't even register on the radar for LVMH, unfortunately. It is a small piece of a small segment of a big conglomerate. And although it's going to double and they are going to grow, the shareholders themselves aren't necessarily going to feel that. And so I think that return for me is we need to focus on a bigger picture. How can they grow the entire enterprise? All right, well, upcoming is going to come, I'm going to end the video with a quick montage of my trip to Scotland, see what I saw, and then up is going to pop up here a couple of clips of other discounted stocks that I've reviewed in the past, and check it out. Throw a comment down below. Let me know what you think about the episode, and let me know about what you would like to see next. And I appreciate it. Thank you very much for the time. Bye.